This is Dan Zanger. He was an ordinary guy making a living by building swimming pools. One day he sold his car for $11,000. To buy a new one? No. He had a wild idea. Use that money to try to make it big in the stock market. And the results? Mind-blowing. In under 2 years, Dan Zanger turned that $11,000 into an astonishing $42 million. Yes, you heard me right, $42 million. To put it in perspective, the S&P 500 only gained about 23% over the same time. His return, officially verified, was over 29,000%. What's even more remarkable, he had no Wall Street connections, just a regular pool builder from California who dedicated himself to mastering chart patterns. Now, you might be wondering, sure, but that was during the tech bubble. Can this method still work today? Excellent question. Dan continues to trade using the very same strategy through his Zanger report, and the results are impressive. On average, each of his picks has returned 52% with a holding period of just under 5 weeks. That's a 52% gain in less than 5 weeks. Stick around until the end because we'll apply this strategy live on a real chart so you can see exactly how it works in practice. Let's get straight to it. Before we dive into Dan's specific strategies, we need to understand the core principles he built his entire trading philosophy on. Dan is what we call a momentum trader. He doesn't care about fundamentals, earning reports, or what the CEO had for breakfast. He cares about 3 things: chart patterns, volume, price action. That's it. That's the entire foundation. Now, you might be thinking, wait, that sounds too simple. And you'd be right to think that. But here's the thing. Dan didn't just casually look at charts. He became absolutely obsessed with them. He studied every pattern imaginable: cup and handle patterns, falling wedges, ascending triangles, bull and bear flags, and too many others to list here. And here's what he discovered. These patterns repeat over and over and over again. The market has a rhythm, and if you can recognize that rhythm, you can make an absolute fortune. Now let me break down Dan's 9 golden trading rules. Rule number 1, ensure the stock has a well-formed base or pattern. Rule number 2, once you've established the trend or resistance line, enter a position after the price has broken the line, but do not pay more than 5% above the breakout. Rule number 3, sell quickly if the stock falls below the breakout point. Zanger typically used a tight 5 to 7% stop loss. Rule number 4, as the stock rises, sell between 20 to 30% of your position once the stock has climbed between 15 to 20% from the breakout. This locks in profits while keeping you in the trade. Rule number 5, hold the stocks which continue to rise and sell those that lose momentum or begin to turn down. Dan adds, remember, stocks are only good when they are moving up. Rule number 6, keep an eye on strong industry groups and, where possible, try to make your selections from within these groups. Trade the leaders, not the laggards. Rule number 7, look for reversal patterns to exit your positions. Dan recommends studying candlestick patterns as a good starting point. Rule number 8, volume is highly important to the success or failure of your trading decisions. Look for healthy volume at the point of breakout. No volume, no trade. Rule number 9, never go on margin until you have mastered the market charts and your emotions. Margin can wipe you out. Dan's entire strategy revolves around identifying specific chart patterns and entering at the exact moment of breakout with increasing volume. Let me show you exactly how this works with real examples from his record-breaking period. This was one of Dan's most profitable trades during his legendary run. The stock was an IPO that launched in August 1999 at $30 per share. A couple of weeks passed and Dan noticed a small descending trendline forming. The price consolidated, building energy like a coiled spring. Then boom, the price broke above the trendline with significant volume. Dan immediately entered a position. The stock surged upward, and Dan rode it until the momentum started to fade. As soon as he noticed the upward trajectory was slowing down, he sold his entire position. But here's where it gets interesting. Several weeks later, the stock formed a horizontal trend line, another consolidation pattern, and once again, Dan entered at the break. This time, the stock absolutely exploded, surging to over $190 per share. Dan held the position, watching carefully for any signs of weakness. When momentum finally shifted, he sold. But wait, there's more. The stock consolidated again for several weeks, this time forming what Dan called a high-level symmetrical triangle. Dan entered on the break and sold on the first considerable sign of a change in momentum. 3 separate trades on the same stock, 3 massive wins. Now I'm going to show you exactly how to apply Dan's strategy step by step. But first, I want to thank our amazing community. We selected the user who helped another community member, and we're gifting them 1 free month of Flux Charts, because that's how a community should work, by helping each other out. Please reach out to our email to claim your free subscription. Now, if you haven't heard about Flux Charts yet, this is the platform I use every single day for my trades. It completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part, 90% of their indicators are completely free. Plus, you can use Flux Charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2-indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. First, go to TradingView and open up a new chart. For this example, I will use this stock and this time frame. If you don't have it yet, I'll leave a link in my description. So the way Zanger traded was by combining chart patterns with moving averages and volume. On TradingView, here's how you set it up. Go to the Indicators tab, type in MA Ribbon, and select this one in the Technicals. Now open the settings and activate 3 moving averages, SMA 10, SMA 21, and SMA 50. For colors, orange for the short term, yellow for the medium term, and darker orange for the longer one. Warning: if price is below the moving averages, or if the moving averages are crossing each other, you must absolutely avoid the trade. This indicates weak momentum or trend reversal. Only take trades when price is above all moving averages and they're clearly separated, expanded from each other. Once you've got the ribbon on your chart, go to Indicators and search for RVOL and add it to your chart. In the settings, change the cutoff to 2 and the time frame to 24. This indicator will show you when volume is significantly above normal, the key confirmation Dan uses for his entries. Next, look at the pattern. Here, the stock is forming a tight base just under the highs. See how the candles get smaller and smaller and volume dries up? That's the classic dry up signature Zanger was waiting for. Now watch this. The moment price breaks through the pivot, he didn't just buy on the first breakout. Too many of those can fail. Instead, he waited for what he called the second breakout. Look here. The stock breaks out of the base, makes a strong run, then stalls just under the previous high. Most traders would already be all in, but not Zanger. He watched for price to build pressure again and then smash through that prior high with exploding volume. This second breakout is the confirmation that the trend is real, that the weak hands are gone, and that momentum traders are piling in. After the second breakout, surpassing the previous high, we open a long position, making sure that all criteria are met. Stop loss just below the breakout base with this impressive risk-reward ratio. And this trade exploded into a huge profit. When a stock shows this kind of strength, breaking to new highs with proper volume and moving average alignment, he's willing to add to his position or take a fresh entry. After that explosive first run, price consolidates again. Volume contracts, volatility compresses, and the moving averages stay perfectly stacked. That's exactly the dry up he was looking for. Then comes the breakout. Volume surges, the stock clears resistance, and this sets up another trade with an incredible risk-to-reward profile. Stop loss goes just under the base, while the upside potential is massive. And what happens next? The breakout works beautifully. The trade takes off. But, and this is crucial, Dan's success didn't come without massive risk. During his record-breaking run, his account dropped by 32% in one day. At one point during a bear market, he had a drawdown of 75%. 75%! Most traders would have blown up their account completely, but Dan survived and thrived because he understood one critical thing: risk management through discretion and discipline. Let me explain exactly how he managed risk, because this is where most traders fail. When asked about risk management, Dan is quite vague, and honestly, that's because his system is heavily discretionary. He doesn't use traditional stop losses like most traders. Instead, he uses what are called mental stops. Here's what Dan said: "If a stock doesn't accelerate quickly out of a basing area, then I'll sell the stock promptly during that first day. I'll do this even if I've been in the stock for only 20 minutes, regardless of profit or loss at that time." 20 minutes. That's how quickly he'll cut a losing trade. His philosophy is simple: if a stock isn't moving up sharply right away, then the trade must be wrong. No hesitation, no hoping it comes back, no let me give it more time. For more mature positions, stocks he's held longer, Dan said, "I never use trailing stops, but I will take profits manually when a stock has moved too far, too fast, or for too long." This means he's constantly watching his positions and making discretionary decisions based on momentum shifts. This approach requires immense discipline. You can't be emotional. You can't be attached to your positions. You have to be absolutely ruthless. Here's what I want you to take away from this. Dan wasn't special. He wasn't born with some innate trading talent. He was a pool builder who decided to dedicate himself completely to mastering one specific approach to the markets, and that approach made him millions. If you're willing to put in the work, study the patterns, develop iron discipline, and execute with precision, you can achieve extraordinary results too. Thank you all for your support, and see you guys next time.